Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. This week up, Adobe, the behemoth in the digital space. The stock is down almost 50% from its peak. Let's figure out how much cash money this stock makes. And if we bought it today and held it for 10 years, how much IRR, how much return could we make on our money? You ready? Let's get to work. Okay, before we dive into the 10K, let's review the 5 key attributes that we use here at this channel as a starting point to value any business. Number 1, top line revenue growth. You want to see that growing. Number 2, earnings growth. EBITDA should be growing every year. Number 3, strong free cash flow. Number 4, low debt, less than 3 times debt to EBITDA. And number 5, a well-priced stock. What does well-priced mean? It means if I give a conservative forecast with a reasonable market multiple at the end, I should be able to beat the stock market on my return. That's what we want. All right, the first thing we need to do is we need to review the 10K. The 10K is the annual report filed with the SEC for any public company. And we want to take a look at the balance sheet to make sure, see how much cash they have. So cash is at the top of the balance sheet for the U.S. companies in GAAP. IFRS is typically further down. But what I want to take a look at here is $3.8 billion of cash and cash equivalents. And then they have short-term investments, $1.9 billion. This is basically $6 billion. Short-term investments is cash they don't instantly need. It's basically not in the checking account. Think of it as like a longer term. Think about it as cash in your brokerage account. It's not what you're running your life on. It's not invested in stocks long term. It's still cash. It's just not easily accessible. And so when I look at this cash, I think that's the excess cash. That's what they don't need because they set it aside in a short-term investment line. But $6 billion of cash, most of the assets, $27 billion, is goodwill. Goodwill, which you expect from a software company, goodwill and intangibles. They're not buying, they're probably paying a high price for any acquisitions that they have made in the past. That's resulting in goodwill that's on the balance sheet. They don't have many fixed assets because they're not a manufacturing company, they're a software company. So most of this $27 billion is actually cash on the balance sheet. Let's scroll down and look at liabilities. Liabilities, most of trade payables and accrued expenses are most of the liabilities that we consider truly owed. Deferred revenue is something that they will eventually realize. It's not something they owe. It's like a bank note. It's just revenue they haven't recognized yet. So really, $1.7 billion and $300 million is the short-term liabilities for them. Long-term debt, $4 billion. So add this up, I get about $6 billion of true debt, which matches the cash they have online, the cash equivalents, plus short-term investments. That zeroes out the debt, which is what I really like to see. Let's take a look at the income statement. Income statement for us is very important, right? You obviously want to see that they're growing. Software subscription business is the main part of their revenue stream. So that's Adobe, that's Photoshop, that's Lightroom, that's Illustrator, it's Adobe Sign, right? It's funny, the entire DocuSign company is one small division of Adobe. That's I really like that. That's why I'm not a fan of DocuSign as a business. I think it's a one-off company. This behemoth here, it's a small division, is the Adobe Sign product. But they own Adobe. By the way, there's trillions of Adobe Acrobat PDFs created every single year, which is a phenomenal statistic. So $9.6 billion, $11.6 billion, $14.6 million of subscription sticky revenue. I love to see that. This is products that a business such as myself, even this little YouTube channel, can't run without an Adobe subscription. There's lots of people that are doing the e-commerce thing themselves, and I think that's going to be sticky. Also, because it's very affordable in terms of monthly payment, if inflation strikes and they need to pass through, let's say, $1 a month to their customers, they can squeeze their customers for nickels here and there over time, offset inflation, and their customer base is so broad, I think they can do that with their market position. So I think these numbers are fairly defensible in terms of their stickiness, their ability to hedge off inflation. I do really like that. So that's just one piece of the revenue. Most of the revenue is the subscription. The software, the cost, the variable cost, right? They have very little variable cost. If you think of a manufacturing company, typically you have giant machinery, steel raw materials that you have to buy. It's a software business. Once you develop it, it just auto runs. So this cost of goods sold, the cost of revenue, is very low as a percentage of total revenue because most of the costs sit down here. So gross profit is very high as a margin to revenue because they have very little variable cost. Most of it's fixed cost. Operating expenses is mostly R&D. So researching the very forward next generation of Adobe, and then sales and marketing. How do they market and broadcast their message to the world? The interesting thing here, this sales and marketing is a number that they can dial back. Because the product itself is very sticky, they can bring down advertising and rely on their name for a little bit longer if economic times get tough, and they can defend the income statement by lowering this marketing number, which is what I like. Then general operating administrative costs, it costs them $1 billion. That's salaries for individuals, that's building rent, that's all that stuff, which is a very low percentage of total revenue. Again, I like that. Netting out to $8 billion of operating costs off the $14 billion of operating profit gives you $5.8 or almost $6 billion of operating income. That's up from 4.2. That's up from 3.2 2 years back. So growing, positive. I like that. Let's move forward to my favorite statement, your favorite statement, the cash flow statement. Phenomenal. The very first section of the cash flow statement is cash flow from operations. Remember, there's 3 sections to all cash flow statement. Cash flow from operations, top third. Cash flow from investing, what do they do with the money that they make every year? And then cash flow from financing, how do they finance the business? Down here, you're going to find equity purchases, like equity sale, equity buybacks, dividends paid, debt issuances, and debt repayment. Principals, not interest, but the principal payment. That's what this section says. This section is investing. Both CAPEX, how do I invest the business to grow, acquisitions is here, but also the investing of all that cash they have. You'll see the purchase of short-term investments, the maturity of short-term investments. This is basically them cycling their cash, and you don't necessarily have to pay attention to it. It's not a capital investment like buying property, plant, and equipment. So purchase of property, plant, and equipment. This is buying buildings. This is buying treasury bonds that mature and have to be reinvested. It's different. You want to focus on, did they acquire anything? Are they buying property, plant, and equipment? Then this section here, my favorite section, cash flow from operation. This is how much pure cash money they made by running their business for the year. And again, it can be verified by looking at the cash balance from an audit perspective, looking at the cash balance at the beginning of the year, looking at the cash balance at the end of the year, and tying that with the sales revenue that they claim. They should have some kind of cash linkage between the two. Obviously, there's a margin. You can't just use revenue. But my point is, it's a value that can be measured by an auditor who can go to Adobe's bank and say, hey, give me their bank statement. How much cash do they actually have in your bank account? Versus something like a revenue, certainly on a subscription model, which you can play with how you recognize revenue a little bit and change revenue, but you can't change cash. That's why I like cash flow. Long rant, sorry. Let's focus. Cash flow from operations, $4.4 billion, $5.7 billion, $7.2 billion, all positive, all growing. Same direction as the income statement, which I like as well. The one thing I want to point out here is this line, stock-based compensation. We see this in all the software businesses. Because operating margins are so big, they pay their employees very, very handsomely. And in the last fiscal year, it finally breached $1 billion of compensation. Now, why is this line here? Why is it in the cash flow statement? Because stock-based comp is non-cash. They're diluting you and I, the shareholders, and giving that to the employees as a perk, as part of their employment contract. So what I want to do is, what you should do is you want to take this $1.1 billion and you want to assume they paid it to them in cash. So assume the business, instead of handing pure stock, say they issued the stock, they went to the public market, they sold it, and handed the employee the cash. Because this comp is part of the employee's package. If they didn't provide it, the employee would leave to someplace else. So it's owed, and it's required to keep them to stick around with the company to make the product, to make the revenue. So it needs to be paid out. I'm not saying don't pay it. It needs to be paid out, but I want to convert it into cash and expense it. So this 7.2 is 6.2 of actual cash money that you and I will use to forecast going forward. Okay, let's dive into the detail now and look at 10 years of data and figure out how much this business really runs. Okay, before we dive through the history, I want to do a shameless plug here for my course. In the description below, check out my website, cashflowinvestingpro.com. I teach a financial course that's going to teach you how to do exactly what I'm doing right now. Pulling data out of 10Ks, building a forecast model, create an IRR estimate of what we think this business is worth, and it's going to help you. The market is absolutely rocky right now. There are things that are on sale, like a sale I haven't seen in a long, long time. I'm glad to see it. I'm happy to see it. And I think everybody should be looking at individual stocks and building their own valuation model. It's not terribly difficult. Take some practice. Check out my course in the description below. All right, here we go. Let's look at revenue. 2013 to 2021, 9 years of data. $4 billion, 4.1, 4.7, 5.8, 7.3, 9, 11, 12, 15. Growth every single year for about a decade. That's amazing. It's actually a very, very rare thing. That's a 19% compound annual CAGR. Love to see that. EBITDA is enterprise level earnings. So for us, operating income plus depreciation plus amortization plus interest. So it's basically the operating income line for Adobe because they have very little depreciation, very little amortization, and very little interest. Well, I guess taxes. They have some taxes. So it's not all operating income, but close. $744 million. Grow that to $1.2 billion, $2.4 billion, $4 and $6.5 billion. Now, I checked EBITDA for the last quarter that they just produced, right? This is end of the year fiscal 2021, which is December. They have a March Q that's been released. I looked at that. That's about 9% year-over-year growth for the quarter. So that trend is continuing, not as strong as it has been historically. If you look at that growth rate, that is absolutely monstrous. I think a lot of the work remote growth, they've pulled forward a lot of people who would have joined eventually as a result of the pandemic. So I'd expect forward growth to be a little more muted, but still growing. That's a 30% annual CAGR over this time period. Moving out further, you've got short-term, long-term debt. So this is basically the long-term debt plus current portion of long-term debt and capital leases. 1.5 billion to 4 billion. Very, very, it did grow, but earnings grew much, much faster. Cash, less excess cash. Again, excess cash for me, I use the short-term investment line. Unless they don't have one, some companies don't even bother doing that. They just lump it all into one giant cash bucket, in which case I will look back and see what the cadence of the business it requires, what's kind of the working capital, and make an estimate of how much they should hold, and then any excess I'll manually take out. That's how sometimes that number differs. It's definitely a personal call. There's no real formula here. So $2.3 billion to $2 billion, it's kind of flat over that period of time. Market cap, shares outstanding times price, average price, $30 billion to $272 billion. Add the debt, less the cash, plus the market cap, I get enterprise value. Enterprise value is the entire value of the business. Again, my analogy, think of a home. If you go to buy a home in the market, you're going to pay the enterprise value for that home. You're then going to go to the bank and borrow money for your mortgage, plus your down payment. That's going to combine to meet the market price of the home. What trades in the stock market is only this column, is only the market cap, only the stock. What you're missing is the enterprise value, the amount of debt the business has. And it matters in some businesses more than others. Oil, construction, heavy industry businesses that have a lot of leverage, real estate, these companies that have a lot of, even McDonald's, I mean, they're highly levered. These companies use leverage because it's not shown in the market cap. And what I'm trying to do is teach you how to look at the business as a whole. That's the best way, in my opinion, to look at it. That's why we use EBITDA and not earnings per share. I want to make sure the enterprise itself is sound and is growing. Then I can look at the per share data and know that it's going to have a great foundation. But let's keep going. I'm rambling. I'm sorry. Let's move through this. So enterprise. We'll do debt. Debt to EBITDA. Debt to EBITDA is almost zero. We covered this before. I'm just taking debt, less excess cash. It's basically zero. I like to check that box. Enterprise value to EBITDA. This is the market multiple of the enterprise. So it's taking the enterprise value, the total value of the house, and dividing into that the annual earnings that the company makes. So if there was zero growth, it would take that many years of earnings to pay for itself. That's what we're trying to do. How many years, how fast do you get your money back? Right? In terms of investing, the first rule, right, you want to get return of principal, then return on principal. So let's say figure out if we buy a company, how many years must it operate so that it just earns itself, its money back before it can start growing. That's what we want to do. These multiples are very, very high. And it's high because the stock has been growing, so people are willing to pay a higher premium for a stock because it's growing. It's basically trading in the 40s here, kind of drops into the mid-30s and the 40s. Now the market multiples collapsed. Now that's been down to 50% or so in stock price. This market multiple is 30. Lower than, 27. So it's been here before and went back up, but it's now at about 30. It could go lower. This Fed funds, change in the Fed funds rate is a earth-shattering moment for the equity markets, for actually all assets. This asset bubble is finally popping. So we're going to see these multiples come down. We are seeing them come down, and they're going to go down much, much lower. But let's keep going. This is an overview. Revenue checks the box. EBITDA checks the box. It's decent value. Let's go look at free cash flow. Okay, behind me is the cash flow, the adjusted number that I have taken out stock-based comp. Still strong growth, 29% annual growth rate over time, which matched the EBITDA growth rate that I showed you before. So accounting is doing their job, expensing cash costs that come in to the business. Good job, team. CAPEX is very low because they don't buy much capital equipment. It's all software. So this margin here is super wide. It means cash flow is going to pass through to you and I, the equity holders. The next column here is debt. This is principal payment of debt, not interest. This is principal inflows and outflows. And we covered this earlier. The stock itself has very little debt. So every year, they're not leveraging the business. So what happens is at last year, 2021, they made $6.1 billion of adjusted free cash flow. That means at the end of the year, they had $6.1 billion of cash piled up in their bank account. They're like, what do we do with this money? Okay, let's peel off $350 million to buy new paint, new computers for the office, tint the windows, whatever, work remote stuff, that kind of equipment for CAPEX. No big deal. Okay, well, $350 million minus $6.1 billion leaves my mental math is killing me, $5.7 billion left on the table. That's a lot of jack. What do they do with it? Well, it comes to you and me, the equity holders. That's where it goes. So it passes this way as we come to the free cash flow. Debt, they didn't issue any debt. They don't have any debt to pay off. So all that cash goes right here. This is what we wanted. This is the value column of the business. When traditional value investors value a business, you're valuing it based on the cash money. That's why we buy stock, is how much cash can it produce for us. The price gain is good, but nobody can forecast what the stock market's going to do. So why bet on price growth? Go after the cash that you can actually measure and count. And this cash flow was $5.8 billion last year. That's a lot of jack. Then I look at the number of shares outstanding. This is the fractional ownership that I can buy. That's right. When you buy stock, you are an owner of a stock. Incidentally, if you're buying Starbucks right now because the stock is down, you are part owner. You should get in there and talk to the employees about the unionization because it affects you. You're an owner. Maybe not, but check it out. Shares outstanding. So they've gone from 513 million shares to 481 shares. They're buying back shares with this free cash flow. That's a 1% annual reduction in outstanding shares. That means if you bought share here and never sold it, your percent ownership in the business has increased. You now own more of a larger business because their earnings have grown, and you never had to put another dime into the company. You never had to pay taxes on that. You never had to invest more money. This business simply grew, and your ownership interest in that has grown as well as a percentage. Fantastic. I like to see that. Cash flow per share. So I'm just dividing these two. So now what I can do is I can look into the market and say, well, this business last year made about $12 in free cash flow. Now, what do they choose to do? They can pay a dividend. They could buy back shares. It could sit on the balance sheet. They could go acquire other companies with it. Whether they give it to me today or they give it to me in the future in terms of share buybacks or what have you, it's my pro rata share cash flow of the investment I made in their business. And I want to count that in my investment return going forward. Then I can look at the stock price, say at the end of last fiscal year in December is $567 per share. Whew. Well, if the stock only yields 12% cash flow annually, and I'm paying $500, that's a 2% free cash flow yield on a stock, which historically seems about what it had always yielded. I will tell you, though, that other stocks that we have looked at, both on this channel and if you join the Cash Flow Club, shameless plug, link down below, Cash Flow Club, go get a one-pager, looks like this, and I summarize a lot more stocks every single month, some that are yielding 20% IRRs in this recent down market that I release to the Cash Flow Club because I can only do a video once a week. But I'm releasing, half a dozen or so stock picks every month in the Cash Flow Club. But when you look at the Cash Flow Club and you're looking at stocks over and over, lots of different stocks, you get an idea to look at this and say, you know what, that's really low. You can buy stocks right now that are yielding 10% free cash flow, 12% free cash flow. So a 2% is very, very low. And it's going to affect our forecast. All right, let's go forecast this business, figure out how much it's worth. All right, let's forecast our business. So what we're going to do is we're going to pick up the EBITDA from 2021, and I'm going to grow it 10% year over year. When I look at the latest quarter, they grew 9% year over year. I think they can do 10. It's a reasonable round number. Who knows what's going to happen? But I did continue the growth. I'm not slowing them down, even though there could be a recession coming. I think the business is sticky and profitable. The more work remote people do, the more side hustles people have. I think they're going to have to sign up for, in some way, the services that Adobe generates and produces. So I kind of like that. I'm giving them a growth 10% annually and bringing it down over time. That means I'm going to get just shy of $16 billion of EBITDA out 10 years from now. Now, what I did is I added 20 times market multiple to this $16 billion because most of it's subscription. And I'll remind you that historically it's traded in the 40s. It's currently fallen and it's trading at the 30s, 29, and I'm saying out in the future, it's going to be 20. So this market multiple continues to come down. That's going to be pressure on price, and the price of stock is not going to appreciate as fast as earnings are growing. That's a risk to us. Long term, we could be totally wrong with this number. If interest rates were to normalize for inflation, you would set the Fed funds rate equal to the CPI. Recent print is 8.6% back in May. They would make the Fed funds rate, the lowest interest rate, 8.6%. That's a 8% rise in interest rates. If they did that, think of that 8% higher mortgage rates. Mortgage rates now are maybe 4%. That means a 12% mortgage. No. That means price comes crashing down if that happens. And the Fed's well aware of that, but that's what we're facing. Leave inflation high or raise rates to bring down the economy. And when that happens, market multiples fall. So this multiple could be 12. It could be 8. Who knows? I gave it a 20. I think there's some risk there to the investment because you're relying on a higher than average multiple. Let's keep going. So then 20 times $16 billion, $320 billion. I peel off a little bit of debt, excess cash I kind of left alone, and I get $315 billion of market cap out long term. 481 was the share print last year. That gives me a $656 price target for Adobe out 10 years, assuming all this pans out. Now, free cash flow, same principle. I'm going to pick off the $12 number I saw last year, going to grow at 10%. I'm going to follow the growth rate. The growth rate's the same as EBITDA because the business itself has very little CAPEX, so I expect EBITDA to mirror free cash flow. We saw that before in adjusted free cash flow, 29%, EBITDA growth of 26%, so they're really close to one another. That means roughly $30 of cash out 10 years. I can assign a market yield of 4%. They're currently at 2.1, so I'm doubling the yield in terms of, that's like having the multiple, right? So it's the same kind of thing. Higher yield, lower multiple, same thing. 4% yield gives me a $730 price target out 10 years. Okay, so now I have two price targets. I've got One at 731 based on a free cash flow method where I look at all the cash flow outgoing for 10 years and applying a market multiple. I get an EBITDA, enterprise value market multiple, just look at EBITDA. If I split the difference, I'm roughly $700. I look into the stock market, I can buy as much stock as I want, $393 per share. Now remember, that was $650 just in December, so it's down almost 50%. And the stock continues to fall. It might continue to come down, so we want to keep that in mind. But this is basically $700 out long term. If I put this into an economic model, what do I get? I get a share distribution. This is my pro rata share of all the cash they generate each year. I can buy the stock for $319. I think I can sell it in the future for $694. Here's my net cash flow. That means it's an 11% IRR, which beats the market. I mean, the S&P 500 is supposed to do 10% annually for any 10-year period of time. I think the odds of that happening this next 10 years are very, very slim. We have a lot of price pressure that's going to have to come out of the market to make 10% of the next 10 years. But nevertheless, I'm not sure that this warrants the risk of that 10% annual growth rate that we need to achieve and a 20 times market multiple. There are some other deals in the market that I think are very attractive. So for me, this is we're gonna hold the review for a second. Let's look at a distribution chart. Right now, $393 per share gives me an 11% return. If the stock goes up by some miracle, the return falls. If the market continues to fall as the Fed raises rates, what's happening in the market, right? As they raise rates, bonds fall in price. That means bond yields go up. As bond yields go up, bonds become more attractive. The whole reason people are in the equity market is that they're yield chasing. They have been for a long time. All the pension funds that need to make interest for their pensioners, if bonds pay zero, but I can get a 2% cash flow yield in the stock market, all the money moves to the stock market and the real estate market. But as bond prices fall and yields rise, that money is going to be pulled from the bond market, from the stock market, and from the real estate market. That cash can be pulled into guaranteed payments of bond interest of 5, 6, 7, 8%. Safe guaranteed money. That outflow of equity market, that outflow of the real estate market is going to reduce market multiples. It's going to reduce it's going to increase cap rates for the stock market. So I think the market multiple compression that we're experiencing could continue. And if it does continue and the price falls, I think the stock becomes much more attractive. Take off another $100, it's really attractive. So for me, let's recap the 5 key attributes. Number 1, top line revenue growth. Yes, check the box. Number 2, earnings growth. EBITDA, check the box. Number 3, strong free cash flow. Yeah, they have strong free cash flow. Number 4, low debt. Yeah, it's 0. And number 5, well priced. No, I don't think it is. I'm going to give it a meh right now. For me, it would get the good rating if you took $100 off the price. Why? Because I'm looking in the market, I'm looking at lots of other opportunities. You have to remember that you only have so much cash to put to work. So the stock market, investing is not about finding the best stock. It's about excluding all the other stocks. It's a subtractive game, not an additive. So when I look at this stock, I think double-digit growth, great. Market multiples still high today at 29 times enterprise value. I still think it's high in the model at 20 times. So that could come down. So those are my 2 factors. Growth could be lower and market multiples could continue to fall versus some of the other stocks in the cash flow club are trading at 6 times enterprise value. And I need 3% growth or 2% growth annually to make 15% year-on-year return for 20 years. That to me is a better risk-reward trade-off than something like this. I love the business, don't get me wrong. I love the stickiness, I love the product, I use the product. I think it's all, but I think the stock itself is so popular. It's been so overpriced, it's got some room to come down, and I just would stay away from it. The risk return there isn't for me. Now, if you like this review, I would really hit the like button, subscribe, maybe share on social media. I really appreciate that. But more importantly, down below is a link to my website, cashflowinvestingpro.com, where I give you this Excel financial model in the financial course. I walk you through how to read a 10K for the Apple Corporation. We build out 10 years of revenue, earnings, EBITDA, debt, free cash flow. We recalculate, we adjust for share splits. I teach you how to adjust for share splits. and we build out a forecast model. I show you how to create market multiples, how to estimate long-term return, and what an IRR looks like. And what you need to do, you need to find 20 to 30 stocks, build yourself a tight portfolio that you want to own for 10 years, and you're owning these businesses. We're not trading in and out of it. You do that, set it aside, and go live your life. Don't trade. It's a fool's errand to pay the taxes on any kind of gain. You're giving up 30% of your money on taxes, and you have to start all over with lower capital. Leave the money in for 20 years. Leave it in for 30, for 50 years. Find a company you can hold and gift to your children. By the way, if you gift it upon your death, it's tax-free. So then you can pay zero taxes. So my point here is you find the absolute very best stock you can, you buy it, and you hold it for absolutely as long as you possibly can. Check out the course. Also, in the upper left corner of my website, you'll see a link to the Cash Flow Club. I am printing out endless one-pagers. There are some stocks in there yielding 20% IRR. It's a $15 a month club, but what I do is I give you 10 years of financial information that we just did. I give you the forecast on free cash flow and enterprise value, a stock chart, a write-up, and I summarize the 5 key attributes right there for you. We are minting these things like crazy. I'm hiring analysts to build out the team more and more, and I will caution you, I'll absolutely caution you, there are other products and services out there. There are lots of them. But all that screening data that people use, it comes from a few places, S&P 500 and Bloomberg. It's all the same data source that people are pulling. They're just putting funny, nice visual effects in front of the same data. And what that means is everybody's looking at the same stock screens. You can't use stock screens. You just can't. You need to go pull a 10K up, sit down with a cup of coffee, a tea, a whiskey, in your favorite chair, and read it. Build yourself a model, do that for your stocks, and you will have better results long-term than trying to use a screen which millions of other people are looking at the same numbers. The thing I did about adjusting free cash flow, nobody's doing that on the stock screens, and so they think cash flow is too high, or rather, they're using a number that is too high. So I highly, highly recommend. Also, down below in the link, you can get a sample free one-pager. In the link below takes you to my website. Definitely go get it. Again, thanks very much for the support. I really appreciate it. I hope everyone's doing well and safe in this new year. Up is going to pop a couple of stocks for your review if you like continuing to look at value stocks. Definitely check those out. Hit the like button. Hit the subscribe. Share on social media. I really appreciate all the assistance. And I'll see you next week. Thanks, guys. Bye-bye.